Hi, welcome back to the personal finance course. This is the second section of 3 in the chapter on mutual funds, and I'm Tom Mihawk. Glad to have you back. This first slide talks about taxation of mutual funds, and we've been talking about why they're so important, mutual funds, because so many people own them. You're very likely to own mutual funds. How they're put together, why they work, professional management, diversification, number of other reasons. Now we're going to talk about taxation. And certainly taxes are created when you sell shares at an amount greater than what you bought them for. That difference between what you bought at and what you sell at, that difference is called a capital gain. And unfortunately, though, you don't pay tax on that capital gain until you sell the shares. Also, you pay taxes on distributions of income or dividends, and you should be careful to look to see what tax rate you would pay. In general, and what I mean is that sometimes those income and dividends are taxed at, sometimes the income and dividends are taxed at ordinary income, sometimes at long or short-term capital gains, or preferential treatment compared to ordinary income. So just make sure you're aware of which they are before you take a dividend or income if you have a choice. But lastly, a really important thing to know is that capital gains are distributed to you through the fund on sales in the portfolio. So, and it's net sales, meaning sales less purchases. But the point is that when capital gains are created on sales of securities in the portfolio, they're distributed to you, and you pay tax on that on an annual basis, unless, of course, it's owned in a qualified plan like a 401k or an IRA. So you should know that. Higher turnover, more sales creates more taxation. There are challenges too when funds need liquidity. When funds need liquidity, and if there's not enough cash in the mutual fund, they have to sell securities. If they sell securities at a gain, it creates capital gains. And they sell these securities to create liquidity, to provide cash for redemption. So when this happens, you have to be aware that higher turnover, greater selling of securities is going to cause capital gains that are then distributed to shareholders. So costs are important. We know from our stocks chapter, we know from the investment fundamentals chapter that in general, keeping costs down is important. But net returns matter too. So the gross fund return less operating expenses is equal to your net return. You take the gross amount of return that the fund produces, subtract its expenses, and you get its net returns. If you find funds that have high costs that produce consistent or exceptional returns, consider them. If you're getting consistently high net returns, consider those. If you need a fund in a certain asset class for diversification purposes and its costs are higher, it may be more beneficial to have its diversifying effect despite its higher costs. I'm thinking of 401k plans, for example, where these days most plans have maybe 15, dozen, 15, 20 at the most. Used to be you'd had 40. That was considered really good. Today we know that fewer funds are better vetted, curated, so that we have fewer funds and people make good choices and don't get confused about their options. So if you only have the opportunity for diversification of a fund that has higher expenses, you can still choose it. It still may make sense for diversification purposes. But overall, a bias for lower costs produces better returns over time for the average investor. If you're someone who's busy, if you're delegating this to someone else, to an advisor, if you believe that keeping your costs down are going to be better for you over time, the records show that most active investors don't beat the markets on average over time. So most people benefit by having a bias for lower cost investments and lower cost mutual funds. Mutual funds come in a variety of investment objectives: large, mid, and small capitalizations, and others described by the size of the securities they buy or the companies they buy. Could be growth or value. Growth meaning buying securities that are more expensive relative to say $1 of earnings. There are conservative and aggressive growth categories. Value, as I said, blue chip, companies that are, say, consumer goods companies like Procter & Gamble, for example, that are blue chip. They produce in good markets and in bad markets. Money market funds that are designed to produce cash returns. And funds of funds that invest in a variety of funds that are designed to provide diversification even across asset classes. Funds invest in different industries like technology, pharmaceuticals, manufacturing, and consumer goods. International funds, Asia specific, for example, Europe specific, for example. Index funds we all know of to access passively invested portfolios, like in the Standard & Poor's 500 or the Wilshire 5000 or the Russell 2000 or the EFA. These indices give you the average return of that index over time. And in general, you should look at these to keep your costs down. Asset allocation funds that build diversification by asset class into their portfolios. And lastly, balance funds that invest in both stocks and bonds. Mutual funds are a commercial enterprise. They are designed to be selected by investments or selected by investors or recommended by advisors. And so if a fund company finds an asset class that that investors are interested in and they think they can gather assets with it, they'll build it. Long and short positions. This is important. Most mutual funds invest only long, meaning, and let me show a picture here. You can see this. So when you invest long, you're buying first. This says now and says the future. Long is in black. So you're buying first and selling in the future. Idea that you're buying low and selling high. Short positions, you sell first and buy back later. Now that may sound confusing, but this kind of investing is available in the market. So long, buy first, sell later. Short positions, sell first, high, buy back low later. Now what does that mean? That means that if you're investing long, your maximum gain is infinite. So you're buying here, and it can go, if it goes up and up and up and up and up, your maximum gain is infinite. And the maximum risk is this amount of your purchase price. This is all you can lose as your investment. However, if you're short, you sell first, you need to buy back to close out this transaction. And if prices go down, you buy back lower and you're in better shape. But if prices go up, your risk of loss is infinite. And your maximum gain is just the proceeds between the sell when you sold and your buyback in the future. Standard mutual funds invest only long. It's considered more conservative. It's considered safer, easier to understand. Many funds, hedge funds for example, invest short. And well-known investors, Sam Zell, Bill Ackman, maybe Warren Buffett, I can't think right now, but I'm sure he has considered or has invested short, invest short. So most mutual funds available commercially, however, only invest long. And many believe it's more likely for securities prices to go down with bad news than go up with good news. It's like in a sport like soccer. It's a lot easier to destroy an attack than it is to mount an attack and score. Mounting an attack to score requires coordination and teamwork. You need that too to defend well, but it's easier to destroy an attack even with just luck. And the same thing people believe is true in the markets, that securities prices go down on just a whisper of bad news, where a whisper of good news, the market is slow to increase. So important difference between investing long and investing short. We've talked a lot about active and passive management. Actively managed funds attempt to beat the market or their benchmark index to produce alpha. Alpha is that measure of return which is where the return exceeds the expected return or exceeds the benchmark. Passively managed funds imitate their benchmark index, return the index return less fees, which should be small, by the way, should be small. And they produce beta returns. Beta meaning the correlation between two securities. If the market's up, and the beta of the mutual fund is 1, it's going to be up the same amount. If it's down, it's going to be down, market down, the fund is going to be down the same amount. If the beta is 2, market's up, the fund is going to be up 2. Portfolio turnover measures how frequently securities in a fund are replaced in a year. It's calculated as the minimum securities purchased or sold, minimum of securities purchased or sold over a particular period divided by the total net asset value of the fund. So if all securities are replaced over a certain period, that's a turnover of 100%. If half of them are replaced, net between sales and purchases, that's a 50% turnover. In general, people view higher turnover as more risky, and there are some studies, some research that shows that funds return lower amounts on average, with higher turnover. Look to net returns to determine if the turnover is too high. I have to say though, I had a colleague I worked with, he had the #1 value rated, large cap value rated fund for some period of time, I forget, a few months, part of a year, maybe a year, I don't remember, but it was like the #1 fund out of 930 funds. It was a real accomplishment. And he had high turnover, and people would ask, why is your turnover so high? And he would say, well, if I like a company and its price is going down, I'm buying more. Its price is going down, I'm buying more. If a company I don't like and its price is going up, I might be selling out of it. And so his turnover was high, but he produced exceptional returns. And particularly as measured relative to all the other funds in his category, which was large cap value. So that's turnover. Environmental, social, and governmental funds are popular these days. Environmental having to do with resource depletion, greenhouse gas emissions. Social having to do with communities, health and safety, working conditions. Governance having to do with executive remuneration, corruption, board diversity. These ESG funds, as they're called, 25 years ago, probably the majority of people said, you know, we don't care so much how the fund, they invest in. I mean, they don't want people to invest in criminal activities, but they would say things like, well, if they invest in casinos, we'll accept that. Or if they invest in companies that make tobacco products, we'll accept that. Well, today people are more discerning, and some want to put their money where their mouth is and invest in funds that do good in their view relative to issues that are important to them. These are called ESG funds, and there are more of them now, and many of them are providing high returns. The last slide for this section are target date funds. Target date funds are very popular today. You will likely see these in your 401k plans. Sometimes they're called complete portfolios in one fund. It gradually shifts to less stocks and greater bonds as you age and get closer to retirement, lowering your risk. The fund manager maintains asset allocation mixes and rebalances for you. It offers broad diversification. It's a great way to invest as a young person, as for anyone, frankly, but as a young person to invest for their retirement, because the portfolio manager is managing the risk for you. You don't have to make changes. The challenge, though, with target date funds is there are no industry standards yet. So you should review performance, review costs, review the rebalancing that's done on a regular basis. Fund companies may do it differently from fund to fund. They're largely the same, but not identical. You should be aware of how they're doing their rebalancing and how they're gradually making these changes. Remember that the standard in the industry has typically been take 100, subtract your age, and that's the amount of stocks you should own. So if you're 25, you should own 75% stocks and 25% bonds. Some people use as that number 120. So 120 less 25 would be 95. So you should own 95% stocks and 5% bonds. If you're 60, you should own 40% stocks and 60% bonds. Now, that's just a rule of thumb. There can be lots of chances. A 60-year-old willing to take more risk and investing for the longer term still will have more stocks in their portfolio. But the point is that that's a rough estimate of how target date funds work. They lower risk over time and as you get closer to retirement so that you don't have to do it yourself. And you'll see a lot. Target date funds have gathered a lot of assets and they've become very popular. This is the end of the second section of the mutual funds chapter, and I'll see you for the third. Come on back.